Hello ladies and gentlemen, and welcome back to another video. My name is Waqar Asim, and today I'm going to be going through a breakdown on a very nice trade on GBP JPY. I'm actually going to be joined by the man himself, Wali, who gave this trade out as a signal to the community, and this trade played out to a 1 to 140 risk reward trade that a lot of our community members did catch because Wali obviously gave it out beforehand as a full trade idea. And obviously we're going to today discuss not only the setup itself, the entry, the stop loss, and also going into the trade management, which is obviously very important because risk reward does not necessarily pertain to ROI, and trade management is actually a very important component to maximize not only on a trade to trade basis but actually on a portfolio basis, because if you maximize on one trade and then don't maximize on another, your actually distribution of your portfolio is off. Therefore, that's why you need to look at your portfolio more holistically and have a trade management plan in place to capitalize on those trades that do not always go your way, or trades that actually could have breaking even or hit stop loss, how you manage those, and then obviously managing your winners as well. And that's something Wali gave out as part of the signal. He was giving live updates, which we'll share our screen and show you on Discord, how we were advising the community not only when to take the trade, but when to partial out, when to break even, etc. So yeah, this trade is a particular trade I want to spend some time today covering between myself and Wali. And the reason we want to go in a lot of detail today is because it is combining a lot of things that we teach, and it's something that we consider a textbook prime setup, which is why we had the confidence to actually give it out to the community as a signal, because it was one of those trades we would take 10 times out of 10. More interestingly so to that is that it combines everything that we teach within our core concepts. Now that be structure, that be price action, that be supply and demand, be that smart money concepts, lower time frame confirmations, all of the things that you've seen us speak about time and time again, obviously with the reference of what we are willing to show online on YouTube versus what we show our community. But in addition to that, it was a dual confluence trade, which gave us even more confluence and certainty in that this is a very highly probable trade. And that is because of something I've been teasing you guys a little bit and mentioning here and there, is our new curriculum, our new theorem, that is liquidity inducement theorem. We actually just finished our first cohorts of students, and they have been excelling extremely well, and I'll give you a quick snippet today of that liquidity inducement theorem Discord. Now, liquidity inducement theorem is our way of looking at the markets holistically in a more specialized, specific way, framed for intraday, looking at the daily cycle, looking at what is happening through Asia, what kind of build-up, what kind of liquidity is formed there, what is the purpose of pre-London, therefore Frankfurt, what is the purpose of London Open, what happens during London session, how that builds up, how that affects strategies, how strategies are targets with inducements, be that retail, be that trend lines, be that Fibonacci. Something in my last video I covered in depth, how retail traders are always getting taken out left, right, center with these inducements, and now layering that in with the daily cycle of what is going to happen during London, smart money traps that present, New York session, and then London close of New York. All of these factors throughout the day is what we cover in liquidity inducement theorem. Now, the reason we were happily giving this as a signal to our community is because we had the confirmations of everything we look for in the WWA core concepts, plus our advanced curriculum with liquidity inducement theorem. So when we had both ways of looking at the market that we do going hand in hand and complementing each other and showing us that this should be a sell right here, that's when we were happy to take that trade for ourselves and also give it out to the community. And this is not something that is rare. This happens time and time again, which is why we've structured our curriculum to have it as a progressive state where you come in, you do the WWA core concepts, that gets you specialized on an intraday macro perspective, and also looking at swing trades, looking at lower time frame confirmations, and then we specialize later on with you guys on liquidity inducement theorem, going really into depth on lower time frame price action within a daily cycle, and looking at a lot of things that we've created, a lot of custom softwares we have for the community, and a lot of tools we have in place to help the students capitalize on an intraday perspective. Now, when these two come hand in hand, it becomes a magical, powerful thing, because we're looking at the market from a whole bird's eye view, going down to the finer details of the lower time frames, and therefore it is a holistic approach to intraday trading. And this certainly was a beautiful setup because the daily cycle lined up to be a sell, lining up with the higher time frame structural points to give it as a swing, which is why we had multiple targets, and that's how we were able to capitalize 1 to 140 risk to reward trade. It's not the first time our magician over here, Wali, has given a signal. Maybe I'll ask him to do a quick rundown on a few of the signals that he's given to the community and also to the public. I remember not too long ago he did give a signal to the public on his public Telegram. That was a 1 to 100 risk reward. Either way, I don't want to waste any further time, so let's get right into the breakdown. I'm going to be bringing Wally on board, and we're going to be doing the breakdown together, going play by play, candle by candle, to hopefully embark some knowledge on you guys and hopefully take some value for you guys. So yeah, let's get right into it. Okay guys, so I am joined with Wally now, the man himself who gave this as a trade idea and a signal to the community. So I'm going to be passing over to him, and the way we're going to do it is he's going to give you a macro view of the whole thing from higher time frame down, from the weekly working his way down, and then the lower time frame stuff I'm going to cover with WWA core concepts, and then more advanced stuff with our liquidity inducement theorem. And then Wally, I'll pass it back to him to cover the trade management within. So yeah, I'm going to quickly share my screen and we're going to do it hand in hand together. So Wally, over to you.
Hey guys, Wally here. So I'm going to start off by breaking down the signal we sent on Discord, and then we'll go in more depth from the weekly time frame all the way down, so you can just have an idea of what was all the thought processes behind the position. So if you come into our Discord chat, you can see within Educator's chart, I sent the trade out. I believe this was on the 4th of June, so on the day the trade played out, around 2 hours in advance. So it was almost an instant profit trade. This was on a Friday, so the management of the trade was a little bit affected. Getting into a position on a Friday, market closing, depending on how much profit you're in, you have to manage how you take off volume, so on and so forth. So I'll run you through all of that. But starting off from the higher time frame down, from the 4-hour perspective, you can see the market was bullish. You can see there was a low, high, higher low, higher high, higher low, higher high. And this might raise the question, why are we looking for such a swing trade within such a bullish market? So this is why we need to start from the weekly perspective, so you can understand where the sell bias came from, and also M15 and below, what gave us the confidence to take a sell. Also, if you look here, I gave out all the targets that we're looking to take, target 1, target 2, and the final swing target here. So that was the H4 perspective of GJ. Let's take a look at the H1 perspective. H1, you can see that more closer to that price action, we had internal bullish structure, but at the end, we tapped into some form of supply zone, which I'll break down from the weekly, and we started making lower highs and lower lows. So some form of bearish market structure started to take place. We can't say the H1 has shifted bearish, because the actual structure point for H1 was all the way down here. This is the true low that created the most recent high, but we can see at least some form of complex pullback has started to form in this time frame. So that was the H4 and H1. Now if you take a look at M15, it'll give a little bit more detail in terms of what was happening in terms of smart money concepts. So you can see, again, this is just the internal bearish structure that took place. We tapped into a supply zone here. You had a high, you have a low, you have a lower high, lower low, and we formed this lower high here. Okay, so right now we can anticipate a lower low to take place. But also, if you look at the context of this, we had the equal highs and an FU candle, and price just came to mitigate these previous equal highs and FU candle. So right now we got some internal structure in our favor, and also we got order flow in our structure in our favor. Okay, now if you take a look at the M3, so the lower time frames now, M3, we had internally price became bullish here, where you had low, high, higher low, higher high, higher low, higher high. You had a BOS. When we go into the lower time frame in more detail, you'll see that this was a distribution as well, so it gave us more confidence in this. And then this was the last buy before you sell candle, where this whole move took place from.
Just to briefly add in, so as we can see from the markup, while he hasn't included the weekly, he hasn't included the daily, and he hasn't gone too into depth into the lower time frames. The reason for that is this is for the community. Remember, the community has been taught everything we know, and therefore they understand the context, so we just need to guide them a little bit. But when it comes for you guys on YouTube, we're going to have to build the story a little bit more for you guys and go in a little bit more detail, which is why we have more detail on the markup as opposed to what we already sent to the community, because the community already knows. They can see this and piece it together themselves, and then they see the point of interest we are looking to take, which is the blue box over here, which is our sell zone, with liquidity right over here. And then we're going to speak a little bit, when I come into my part, speaking about the smart money trap and things of that nature, how we were able to counteract that and then get into the sell.
Okay, so continuing on, we had so bullish market structure just shifted bearish here at this point internally by taking out this low that made the high. And also, if you remember from the previous picture on M15, this is the supply zone that was created from the previous equal highs and FU candle. So this is that mitigation here, and that mitigation led to a BOS here and also left a fresh supply zone that we can utilize to look to sell from. Now this is an inflated supply zone with the WWA students know how to refine this supply zone into a 2.8 pip stop loss as we had, and you'll see on the MT4 screenshots that maybe our entry doesn't align with this point here. It's because the students know how to refine this area. The WWA students will know how to refine this zone into even lower time frames and into an even tighter stop loss. But when we're giving out points of interest, we like to keep them slightly larger just to factor in different people's broker feeds and different people's spreads, so on and so forth. Okay, so that was a breakdown of the signal that we sent out. And again, you can see it was sent out on the 4th of June. Before anything happened, you can see I'm personally watching this zone, curious to see how New York plays out. So pre-New York, this was sent out. And then instantly, within a couple of hours, you can see the trade already hit 1 to 8 risk to reward. Now, this trade did play out to hit a maximum risk to reward of 1 to 170. We'll get into all of that in a bit. And I also aided the students on how to actually manage this position. You can see 1 to 25 hit, I'm taking volume off, so on and so forth. Okay, now let's go into trading view and take a look at this chart in a lot more detail from the weekly down. So this is, now we're on trading view, this is the weekly perspective of what was happening on GJ leading up to the trade. If you take a look at this, you can see that the main market structure denoted by the red dots is bearish, okay? You can see this impulse here led to this previous low being cleared, okay? And this is the point where it cleared the low. All the blue dots are just referring to the internal structure that took place. So the main impulse is bearish, and then we have a complex pullback up into the supply zone created by the previous bearish main impulse. So that's the context of, that's the weekly context of this trade. Also, one thing worth pointing out is we had a BOS here. So I saw a lot of traders took this market as bullish and we're trying to get into loads of buy positions based on this BOS here. But the true weekly swing point started from here and led to this low being cleared. And now that we've reached these weekly supply levels, we can start looking to get into some form of sells. Obviously, we're not going to get into a position here and anticipate a 2-year sell to create a new low compared to this point here. We react to different demand levels, manage our positions according to what shows up, and we just react to the market instead of trying to predict the market.
So Wally, just to ask, because I'm going to be framing myself as devil's advocate or from a public standpoint of somebody watching this video, they're going to be seeing, okay, we have a bearish impulse like this, where we have created a new low on a weekly time frame. Then we had a retracement, but we had a bullish break of structure. So on a weekly, current price action is bullish on a weekly and the lower time frame. So therefore, would it be sensible to say this is now going to continue to be a bearish market, or is it bearish until a bullish zone? What are the favorable scenarios, and also how would you look at that just from the weekly context alone?
This is basically the purpose of a complex pullback. In a bearish trend, you're bullish until you reach your bearish supply zones. And that's exactly what's happened here. We were bullish. Yes, we're bullish. The immediate trend is bullish. But now that we reach the supply zone, we can assume a new bearish leg to start off. Now, this is a supply zone from 2 years ago. Now, and if you can see, the previous impulse took 2 years to play out, from 2018 to March 2020. It was a 2-year sell. Now, can we speculate a 2-year sell just because we come into a supply zone? No. The immediate trend is bullish, so we're going to keep that in mind and manage our positions according to that. So every single time we come to a demand zone, we're going to monitor how price action reacts. If it reacts favorable to us, we're not going to close partials. But if we see some form of bullish price action coming in, then we can consider taking partials and managing their position. Okay, so the final thing I want to mention on the weekly time frame before we switch to daily is that we want to refine this supply zone here. Obviously, on the weekly time frame, this is going to be a 200-300 pip range. We're not going to be looking for sells within a 200-300 pip range. We want to refine this down as low as we can. Now, I've already done this. This red box refers to the IFC on the 4-hour time frame once we refine this weekly candle down. So what we did was we refined this down to daily, and then we refined this down to 4 hours. And also, just from the dots, you can see the most recent bullish internal structure that we have on the weekly time frame. This blue box here is our weekly IFC candle, or what most people will look at as the weekly demand zone. Now, we refined it down to daily, and this aided us in closing out partials, and you can see a major rejection came from this level here. Alex actually breaks down in the community how these buys would have played out. We're going to leave the buys out for today. We're going to focus on the sells, but when I go to the daily time frame, just to understand where this box is coming from. So this blue box here is the weekly candle, and then we refine that down to the daily time frame. Okay, so now let's take a look at the daily. Now, taking a look at the daily, the more recent price action that happened in the daily leading up to the sell, you can see, so this was the previous BOS point from the weekly level that made a lot of people assume bullish price action and continuously looking for buys. At this point, yes, the price was bullish until we reached the supply level. So there's multiple buys that we caught in here. If you remember the charts that I showed on Discord, you probably saw that there were previous 1-2 buy positions. We caught a buy position here and a buy position here. But we understood from the context of the market that once prices reach these levels here, we can't look to be bullish anymore. We have to reevaluate our position and see, reanalyze what to do and react to what's happening. Okay, so what you can see what's happening here, bullish market structure. You have a low, you have a high, you have a higher low, you have a higher high. And now this was the weekly candle here. This whole light blue box was the weekly candle, and the thin outline blue box is the daily candle refined down, which is the zone that we're going to use as the main demand when we're looking to take partials or not. So that's the daily outlook. Now let's take a look at the H4. Something really interesting happened on the H4 leading up to our supply level here. You can see price had a reaccumulation. On H1, this reaccumulation is a lot more clearer, and you can see there was internal bullish order flow in this area, a full reaccumulation, multiple times liquidity was built up and taken out, and you can see there's multiple sets of equal lows sitting here as well, and there's a retail trend line trap as well. So there's multiple things sitting in this region here. There's multiple reasons to assume that this could be a demand level as well, even though you can see no demand level actually held within this area. But a lot of people would have assumed this as a demand level just from seeing the price action that took place within this box here. Now, after we tapped into the supply level, you can see on H4 this little internal structure is starting to become a little bit more apparent. Now, in the context of the trade, we took the trade at this area here. So this is everything on the right. We never had that price action available to us. We only had the price action available to the left. So the main thing we had to go off on the H4 time frame was that we tapped into the weekly supply level, refined down to H4, and it was a very clean tap. It mitigated it almost to the pip within a 3-4 pip error, and then it started forming a high, low, lower high, lower low, and that's the price action that we had to go off. Now, if you take a look at the H1 time frame.
Just to briefly add into this, so right now we have to really take care with our multi-time frame analysis, because we have a story being built on the weekly, we have a story on the daily, we have a story on the 4-hour, and not always will they correlate. So for example, right now we know that weekly overall trend is bearish within a supply zone we are. Now, when we come into the daily, we just see a bullish break of structure on the daily, and we're coming into our supply zone bullish. The daily is bullish. When we look at the 4-hour now, we are in between zones where we have our supply zone to the high, so that's going to be telling us sells, but also we are coming in bullish where we have been tapping off demand zones. We have these plays on liquidity over here, and we had that bullish break of structure. So right now we don't know what is the overall trend from this time frame. The direction, is it bullish or bearish? When we look in more detail and we see, okay, what is the actual structural point saying and what are the impulses and retracements saying, we have an impulse from this low to this high, so a bullish impulse, and within that bullish impulse leg we had a fractal reaccumulation. I'm going to cover a little bit more in detail later on of the characteristics of that, but that bullish impulse led to a weekly supply zone refined down, as Wally mentioned. So now that weekly supply zone, we have tapped into that, and now we have seen characteristics shift. We have seen that lower time frame, as in the signal Wally mentioned to the community. We are seeing that lower time frame starting to develop, and that's developing in a bearish manner. That means we could say our higher time frame weekly was a supply zone and lower time frame is aligning. Therefore we can speculate that it's going to be a sell, but the way we manage it is important. Is that a sell for weekly lows of a 2-year sell, or is that a sell down to our shakeout area of our reaccumulation? Is that a sell down to our demand level over here, or is it a sell moving forward? And that's something we need to consider when we are taking this trade. I'm actually going to put it into replay mode like this and cut out like this pre-trade. So this is what we were seeing in the market as price was coming in. So all we can see right now is that it's bullish, and therefore if we are looking to sell, we cannot just sell because it's a supply zone. We need to layer in our confluences step by step, and once we have a good checklist to confirm it's a sell, that's when we'll be looking to take those sells. Okay, so taking a brief look at H1, we can see that we are coming in bullish to our supply zone, and what you need to read into the details is of this reaccumulation. And as I've said time and time again, schematics are just semantics. You're just labeling things. This can be read as, from a retail perspective, it could be a bullish flag. From a smart money perspective, you can see just plays on liquidity. From a structural point, it's just bullish market structure with a bit of compression within. There's multiple ways to look at it. We want to be careful not to get caught in the game of labeling things. We actually need to understand the intentions and the story that is being built. So what I read from this and can denote from this is that we are coming into a supply zone bullish, but before we arrive to that supply zone, we are getting bearish resistance. That's why we had to recumulate. The composite operator had to fight sellers that were coming into the market and have plays on that liquidity to enable more bullish momentum coming out. So this area of horizontal price action, this area of consolidation, let's say, this is where we are having that battle or game of chess where buyers and sellers are playing it out. So what we can see over here, we have plays on liquidity where liquidity is being built. Buyers take, or the bullish composite operator takes price to the low to enable another bullish leg to the high. Once we come back down, we have all of these bullish points over here. That for us can be read as liquidity. We have trendline liquidity over here where we can say retail traders will be looking to buy upon another touch of that trend line. And what we can see is that area was now liquidated and that led to our shakeout. So we had a shakeout. So what we can read from this is that the bullish composite operator is really fighting supply and inducing them or enticing them to enter the market and then taking their liquidity. And obviously, as we know, the lower the price comes, the more inclined sellers are to take profits. So there's a whole dynamic that is going on in this area. And then when we come to this area of compression, where we are coming into a focal point, we can see that it's building a trap to the high side of a trend line for retail traders to be entering the sell. But when we look at the internal bullish order flow for the buyer's side of that battle, we can see that we are getting multiple plays on liquidity. Right here, we can see equal lows and then a run of liquidity that enabled or fueled that push to the high. So overall, reading this, what I can see is we are in a bullish market, but it's starting to decompose because sellers are coming in. And now once we have that last bullish impulse where we have a push from here to here, realize that this is not necessarily a structural point. And I'm not going to cover too much in detail why it's not a structural point, but we need to start to see that's where the intent for the bullish push came into. So that's why we refine this area down as target 1 and then our shakeout area as target 2. But again, you're not just reading and labeling structural points, you're not just reading and labeling Wyckoff theory points, you're actually reading the story within. So all we can take from this time frame is we have a bullish push coming in derived from this point and originating from a reaccumulation set. So that's the information we take in. Price taps into that supply zone and we get that deterioration where we are getting bearish confirmations. I'm just going to put it down to a lower time frame and Wally's going to explain a little further.
Okay, so as Wakar mentioned, this area here is not really a structural point, but at the same time we need to understand that on the left there's a set of equal lows sitting here and also below it. So these become liquidity targets. Now if price comes and takes out these liquidity target, structure has still not broken. So even if price is gravitated towards this point, for the H1 time frame, price will still be bullish. Now the H1 area that we showed here, the target 1 is just that refined down. I believe on M5 time frame this was refined down to. And naturally speaking, when you're looking to get into short positions here, look, the internal structure that was high, low, lower high, lower low, lower high. Now you'd anticipate a lower low. A lot of the times people would look to close out the target 1 here, be like, okay, the natural thing for price to do is to make a lower low. But where does price react from? The price reacts from supply to demand, demand to supply. Now below this low, there's so much empty price action here that we can almost guarantee that price is going to tap into this area of demand. So there's a lot of wasted potential by taking your profits at this low here. So
well, yeah, I think it's actually interesting to add here is that if people were to take a trade like this and they say they're in a supply zone on the weekly and they want to see breaks of structure to confirm the sell, so sellers confirmations, that structural break might be down here, but as we know from a structural perspective, it's not even here, meaning you will be so late to the party if you are waiting for a structural break even on M15, because right now all we see is one singular push from here to here with no internal price action to say where is our break of structure. So if we have to remove that from our arsenal of refinements, then we have to look at how is price developing. And that's what Wally is mentioning, that even though we don't have a break of structure to confirm a bearish market, we have internal price action developing in a way that is showing us sellers are present. And second of all, as Wally mentioned, the voids that are here with the imbalances is showing us that it is likely or probable that sellers are in control at the moment. And and we need to find more confirmations on a lower time frame to justify now an entry. But realize, look, we didn't just enter based on impulse retracement, now let's sell it, or impulse retracement, now let's sell it. It's not just jumping into sells when you see lower low, lower high, lower low. You really have to develop your arguments as if you are a lawyer presenting a case to a judge. You really have to have a whole story set built with your evidence sets to justify why you're taking that sell. So as Wally was mentioning, internal price action developing, and then the confirmations that I'm going to cover. But Wally, is there anything else you wanted to add on this before we go lower?
So if you zoom into the most recent bearish impulse on M15, let's take a look at what's happening here as well. This was a final confluence on M15 for me that to look to take a sell in this area. So the first thing was, you can see these equal highs and this FU candle here. So we use this area as our supply zone to look to sell from. Our most recent bullish push was from this point to this point here. So for a BOS to take place, price needs to clear this low here. But we had a very strong level of demand sitting here. Price should have reacted from this demand and created a higher high if the buyers were to be in power in this region here. Instead, what did price do? It came, it formed some form of resistance, created equal highs, and then actually cleared out that demand zone. You can see these little wicks here. It cleared out the demand zone, and that was a sign of bearish intent for us. Now all we did was refine down what's happening on the left to find the point where we're going to set our limits for the sell. But now the full picture of the sell has been built. Yes, in terms of a weekly time frame, we're in a supply zone. Daily might be bullish, H4 might be bullish, H1 might be bullish, M15 to this point might be bullish, but the story is still telling us sells. Why does price have to reaccumulate? It shows that the buyers don't have enough momentum. They need to come back together, build that momentum to continue higher. All these little chapters come together to build the story. Now, most people looking at this will be deceived by the daily, will be deceived by the H1, H4, and completely miss out on this very clean textbook sell opportunity. So now let's take a look at the lower time frame. I'll pass it to Waqar to take you over the M15 and below.
Okay guys, so as Wally has very clearly developed the story for us from the higher time frame, as you can see, there's a lot more to it than just looking at supply and demand, or just looking at structure. And as he was mentioning here, it's a key component that you need to develop as yourself as a trader, which is reading market intentions aside from theory. And here, as we mentioned, the technical structural point to be taking a bearish break of structure is all the way down here. So if you're waiting for a BOS down here, you're going to be late to the party once again. You need to actually read the intent that's here. Now this, once again, is a fractal reaccumulation, and you have to look, where did the buyers come into the market? Yes, the buyers started here, but where did they create a real impulse? Where was that injection of bullish momentum or bullish volume, and as we call it, a decisional point? So when we saw that area has been cleared, we can say those buyers that were previously present have been now taken out or negated by the new sellers that are coming in. And that's the story we are developing. We are developing a narrative that sellers are coming into the market. Once here we see liquidity being built, that liquidity taken to trap out buyers and then enable sells, and that's what happened. So we see bearish intentions playing out in the market time and time again. So we are seeing, despite being bullish overall, bearish narrative is coming into play, and therefore once we develop that narrative, that's when we can justify an entry, and that's what I want to cover a little bit further with you guys. So let's come into M5 to develop this a little further. Okay, so the M5 picture is a pretty interesting one, and I'm sure a lot of people would see this in a very different way. Depending on who you ask and what kind of strategy they are using, they'll develop it in a different way, but that's not what we need to do. We don't need to look at it from a strategic point of view, because you have to realize the composite operator, the people controlling or participants controlling the market, they actually target strategies. They target the liquidity of where stop losses are. That will be stop losses of people who trade RSI. That will be stop loss of people who trade trend lines. That will be EMA traders. That will be indicator traders. That will be Fibonacci traders. Whatever strategy you have, including smart money concepts, including Wyckoff theory, they will all be targeted because they know the stop loss is exactly where they are. Therefore, you shouldn't read it from a strategic point of view. You should read it from what is price telling you, what are the intentions present. So what I can see is we had a bullish push, and once again, this is where the buyer's injection came in with a fractal reaccumulation that happened over here. I won't label it out too much for you guys, but you can see that liquidity was built here. We had a break of that liquidity and a type 3 spring that led to that final push. So once we had that leg of the market cycle playing, what happened? We came into that previous supply zone. That was a previous play on liquidity, therefore seller's confirmation points. What happened in that seller's point? We had a fractal distribution, which I'm going to go into detail. Once we had that distribution, we had a push down that eventually took out that reaccumulation zone. So we are seeing bearish intent developing. I'm going to quickly jump into M1 now to quickly develop that distribution a little further. And as we can see that it is quite a detailed area of price that we need to be reading into. And what I can see from here is that we have price approaching and it is compressing. It is not coming into our supply zone and directly rejecting. What does that tell me? This is a dynamic zone where there is resistance, and that once again a battle needs to take out between buyers and sellers. And in this battle, sellers prevailed. So I need to realize that this is where a conversion happened, where demand came in and then that demand was converted to supply. And if that conversion happened, we know that sellers are present there. And also if sellers have entered money into the market, that denotes a later on mitigation, which is our target later on for an entry. So to look at this a little further, as I mentioned in my previous video with Alex, going into schematics and how liquidity targets are everywhere, how you have these inducements everywhere, how retail traders and smart money traders alike are enticed to come into the market and their liquidity is wiped out left, right and center. You can see that exact same narrative playing once again, and that actually is the purpose of a schematic. It's not the labeling game, it's actually reading those intentions. So right here I've mentioned a few where we have a bullish internal trend playing, we have a trend line playing, taken out. We have now a bearish break of structure. This becomes a supply zone for somebody, that is taken out. We have a resistance level or support level over here, that is taken out. So you can see time and time again, trends are being built, narratives are being built and then wiped out. The idea being that when you're having that compression is that the composite operator is trying to get rid of buyers and is trying to get rid of sellers and make sure they are the only people present. And that's what's happening here. And with the further characteristics of the schematic, we see that we have the sellers start to develop here. Where we tap into our supply zone, we get an internal break of structure, not a break of structure from our structural points, but actually from internal levels. We get price action developing. As you can see, I've marked out over here a minor inducement, something we cover in our liquidity inducement theorem modules, that we have a supply zone over here that led to a low. Why is that taken out? You know, what is going on here? Again, we are clearing liquidity, paving the way only for the composite operator. Once again, a supply zone is left and we have a mitigation of that, but preceding that, a strong resistance level or equal highs or a liquidity target. Time and time again, characteristics are playing out. What we need to do is see that develop and read the details to build our case. So what I'm seeing from here is that we are getting bearish order flow, we are getting bearish intentions, bearish confirmations, bearish break of structure over here, and therefore this red arrow that I've labeled, that is my final bearish push that I'm focusing my analysis on. And where is that bearish push derived from? It is derived from this supply zone that mitigated a previous minor inducement. So as you can see, I have clearly developed this story. It's not just looking at a distribution, it's not just looking at a supply zone, it's not just looking at the weekly level, it's layering in piece by piece where the intentions in the market are. So now that we've marked this out, and that's the same area that Wally marked in his trade idea to the community. As we can see, coming back to it quickly, going on to M3, that's the same supply zone where we have that bearish push, we had that play on liquidity here, we had that internal order flow. That is our point of relevance. Now, it's not marked in that much detail here for the community because the community knows all of this. They've had intense training from us, follow-up calls, community calls, hundreds of PDFs, so they know exactly what is going on. We just guide them from time to time in terms of what we are looking at personally. So coming back onto TradingView, same area over here, and as price develops, now this is where things get interesting, where without getting too lost into the lower time frames, we need to remember everything we've just discussed from the higher time frame, the story that is being built, and not lose reference of where we are. But look at this. So I'm going to show you a little bit of the daily cycle, which is not something we've shown too much on YouTube for you guys. Now, coming into that supply zone, let's look at the clock. Let's look at the times of the day. Again, we have a custom indicator or a custom tool and software we've built for the community to mark out everything that you need to know from within the daily cycle in terms of Asia, in terms of London, in terms of inducement. Everything is kind of mapped out for you guys. But again, I'm not going to show that on YouTube. That's for the community members. But as we can see, as we end the day and now Asia session is opening, it is in this zone. We have a zone where Asia has remained, and therefore we know that liquidity can be built within Asia to later on fuel moves. Now we need to look at what is happening during pre-London, and we can see over here at 8 o'clock, Frankfurt Open, this is actually European time, we have something happening and a move instigated. When we come to London Open, what do? We get a mitigation and another move instigated. Now, you have to actually understand what is happening. These things are not random, these are fully intentional, and there are reasons behind it. And if I was to show you the liquidity inducement theorem Discord, you would see so many details and so many markups just in this small area of price, because price is very important and everything is happening with a meaning and with purpose. Now, what I can show you guys is that we have the liquidity of Asia and these equal highs that were there, and that liquidity has now been taken out during London session. Now, if I play a few more candles, people are going to start to see, okay, I've seen a London push to the high, we've taken out equal highs, and we've had a bearish push, and we've had internal bearish structure. So the average person, they're going to be thinking that sellers are starting to take control in the market. Okay, we haven't come perfectly to our supply zone, but we can say that we are within a supply zone, and we've had a bearish break of structure and an impulse coming down that has cleared previous highs. So very indicative of an FU candle, very indicative of a play on liquidity and a seller's confirmation. We know for the confirmations that we have that this is a smart money trap, and this is where a lot of people will definitely take a loss, even if you are within the niche or edge of smart money traders. Again, remember, every strategy is targeted, and for us, we know that this was a smart money trap for reasons I won't go into detail now, but therefore that's why we did not consider this zone at all, and we actually warned the community that you need to be selling from up here, not down here. And that's loss avoidance when you understand liquidity inducement theorem to a good level. Now, second to that, within the core concepts as well, this is something we cover. And this is now the hand-in-hand mechanism we're speaking of, where we are not just trading traditional smart money concepts. We are not just trading traditional Wyckoff theory. We have combined them in a way to avoid the losses and pitfalls within each strategy. And that's what you need to be doing, looking at the markets holistically and not marrying yourself or subscribing yourself to one particular school of thought, because those schools of thought are actually targets for liquidity. Now, developing this a little bit further, we have that supply zone refined out. We have the timing confirmations that we like. We have the liquidity and inducement confirmations that we like. And therefore, this is a trade idea that we gave out. Entry, unfortunately, I'm not allowed to cover with you guys, but that's something for the students, for the community. But we will show you our screenshots of MetaTrader of where we did get in exactly. And maybe if you spend a bit of time, hopefully you can reverse engineer and get a better idea. But that's where I'm going to leave the entry point for you guys. And this was a simple limit play because we had so many confirmations developed into this, including the liquidity inducement theorem, including the timing, including the fractal distribution and the story developed before from the higher time frame. This was a confident trade to take as a limit. That's something all three of us did. And the funny thing is that Wally and Alex analyzed it together in our office. I was out at that time. I was actually in clinics and I wasn't looking at Discord. I wasn't looking at my phone because between patients trying to take a trade, I actually got into the exact same trade with the exact same entry without speaking to anybody in the community, without speaking to Wally or Alex. Reason being because the strategy needs to be something that different people can see and have their understandings within, because you are not strategically playing, you are understanding market intentions. And as you can see, when you're framing yourself like this, you can actually see that there was no other trade to take. It would be not logical to take a buy when you've just come into a supply zone of a distribution that is playing off a previous FU candle that is previously playing from a weekly supply zone. Now, once you've layered all of these things in, a very obvious sell. Now, just to finalize this trade, I'm going to show you the entry really quickly and show you how this smart money trap, where a lot of people would be enticed to get in and have the confidence that, yes, I have all the confirmations I need. This is a smart money trap. We see that price is going to come into it. We are not going to look to take that trade. It's developing, showing you, look, bears are in the market. It's showing you, okay, this FU candle that cleared this liquidity, hit a supply zone, it's giving you that bearish reaction. It's telling everybody, get into that sell. Right now is a good sell to get in. When price returns, hit that sell button. And that's exactly where stop losses are going to be present. Everybody puts their stop losses in a plate for the market maker, the composite operator, whatever you want to call it, for them to just take your money, take your stop losses. So, and be honest, let me know in the comment section, would you have taken a sell in a similar position, seeing all of these characteristics line up? Okay, and what does it do? It actually gives you a bit of reaction. It tells you, yeah, guys, you were right. This is a sell zone. This is an FU candle. Get in. Right now it's time to get in. Gives you a bit of a reaction and then takes you out. And then your stop loss is taken. But that's where our entry was waiting. That's where we told the community members, this is where you need to be selling for the aforementioned reasons that we have developed for you guys. A limit play right here. Now we are in the trade, and soon after we are price is now truly coming down, and that is the market cycle. That is the intention for the day, and now we expect price to take this low. And naturally speaking, now that we have cleared this low, it's a good time to break even. It could reverse on us. We don't know. We're not in the job of forecasting for weeks in advance or looking into a magic ball. We're just playing price action. Now we have a break-even protocol. We are break-even. Wally advised this to the community. And what I'm going to do actually is pass it back to Wally to show you hand in hand how he managed it, or how we managed it, and also how we gave live updates to the community as to manage this trade. But as you can see, for the entry protocol, a very clean, systematic way of looking at the market, because you're looking not at a strategic point, but you're looking at liquidity. You're looking at plays and intentions of the composite operator or the market maker, whatever you want to call it. We are reading market intentions, not reading strategies. Okay, so back to Wally. If you want to share how you manage this trade and how you advise the community to do so.
Okay, the management of this trade, a few factors had to be factored in. So I actually managed this position differently to how I would manage 90% of these swing trades that I would take. Mainly because the trade was triggered at 3 p.m. on a Friday, so I only had about 6-7 hours before market close. Now anything could happen over the weekend. I don't want to be floating in a significant amount of profit and then spreads open up when Sunday the market opens. Massive spreads happen, and I need to factor in that when stuff like that happens, I could get caught in slippage. The bad thing about having small stop losses is that your lot size is a lot bigger. So when you risk 1% in a 3 pip stop loss, if you get caught in a 10 pip slippage, most people will only lose maybe 0.3% of their account. But for us, that could be 3-4% of our accounts. So factoring on Friday, we need to actually take at least 2-3% P&L off the table, just so that if anything happens on Sunday when the market opens, we're safe. Now, the first thing I did was I advised the community to break even on the position as soon as this M1 low was taken. Because on M1, this is the low that went in to make the high, that went and triggered our position. And as soon as this low was taken out, we know that our entries are safe. So upon this position, upon this low being taken out, we were floating around 1 to 8 risk to reward. I advise the community, break even on your positions. Now, naturally, I will not take partials until I reach the area that I marked out as target 1. In a typical scenario, I will not take any more partials, or I will not take any partials until I reach my target 1 area. And the way I do this is I'll probably set an alert 10-15 pips above the zone. So no matter what I'm doing, I'll get a notification on my phone. GJ has approached this price level. I know mentally that's target 1, and I'll log into MT4 and just take my partials. But considering the fact that we're in a Friday, when it came to around 6-7 p.m., I was floating around 1 to 25 risk to reward, so I advised the community to take 20% volume on that trade.
Let's actually take a look at Discord and go through how you advise the community. So in the beginning, we told them this is the area to be monitoring as so, and then just a few hours later, we see that exactly as I showed you guys, we didn't take that smart money trap. We took the proper entry over here, and now it came down, and as you can see, he's labeling out the internal confirmations we need, and then the break-even protocol. Now, just running through, Wally actually specifically says, and we're off finally out of the range, personally being very conservative with this trades, and it's Friday. Now, because it's Friday, as he mentioned, there's only a few hours to play with before the weekend happens, and then with the weekend, nobody knows what's going to happen, and you don't want to get caught in slippage, as he mentioned. So, as he's discussed, 1 to 25 hit for the day. I'm taking 20% volume off and calling it a week. We'll reevaluate it next week. So, in this specific case, it was a different management because it was not specifically based on the targets outlined before the trade, and because we're dynamic, knowing the characteristics that can happen, taking a bit of volume off, breaking even, so you know you're safe and you're covered, and then next week we go again. So actually, Wally, if you want to continue, what happened the next week?
So now the trade is break even, and when you take 20% volume from 1 to 25 risk to reward floating P&L, you've secured 5% in the bag. Now one thing you need to consider is this is a 3 pip stop loss, well, a sub 3 pip stop loss. So for you to lose that 5%, you only need to be caught in a 15 pip slippage. Spreads only need to open up 15 pips for you to get taken out of that position and the profit you were floating. If I had a slightly bigger stop loss, maybe I'd take only 10% volume off. If my stop loss was just say 8-9 pips, because 10% volume would have been 2%. And in terms of slippage, I need to get caught in 16 pip slippage, which is very, very rare. Normally slippage is only between 5 and 10 pips when it does happen. So we took off 20% volume here. Now we got 80% of the trade floating. So if you go back onto trading view, let's see what happened.
So now zooming out to H1, we can see that our first target has been fulfilled in terms of structure. But again, that's not an area to take partials or volume off the table, because we took some off before the weekend, number one. And number two, we can see that we are in a bearish internal structure is bearish. Therefore, we can see lower low, lower high, lower low. So does it make sense when you are internally pro trend and targets not fulfilled? Does it make sense to take profit there? Not necessarily, because it is more favorable that we are going to come to our demand zone. And remember, as I previously mentioned, this is that reaccumulation zone, that decisional point where that bullish injection came into the market. Therefore, we know that buyers are here. So that is a logical place to be getting out because we are selling. Buyers were historically there previously. There might be something that needs to be mitigated. Therefore, that defines our target one. Therefore, logical to take volume off the table. And that's something that we outlined to the students. So, Wally, when price arrived into this area, what would you have done, or how did you advise the students?
So when price actually arrived into the target one area, we were floating 1 to 65 risk to reward. So I advise the students to take another 30% volume off the table. And there's a reason behind taking around 30% off from target one. It gets rid of your emotional attachments to the position. Because now mentally you can sit there and say, I've made good profit from this trade. And now you're more susceptible, you won't be as upset if the trade came back to break even. So now you paid yourself from the position. The first time you took partials, because it was a Friday, it was just to protect yourself. So you broke even, and then you took partials to protect yourself, and now you've taken partials to pay yourself. Now you've got 50% volume of the trade left to play about with, and to actually monitor price action when it comes to these demand zones to decide, are you going to take more partials, or are you going to hold?
One thing to mention as well, trade management, you don't just have targets and they are just objectively there, and when price arrives you let it do its thing and then you take your partials. It should be as detailed as your analysis coming into the trade, meaning you are following candle by candle, developing that story after your entry as you were developing the story before your entry. That's just as critical. Now looking at the details over here, price arrived to target one. We are very aware that it's a buy zone. So even though we're in the sell, we could buy, we could hedge, and potentially because we are pro trend on the higher time frames, that potentially this could be a buy that can turn into a swing trade. So this is something you need to be factoring in. But that doesn't mean you jump into a buy for the sake of it. As detailed as the confirmations were for the sell, as so they need to be for the buys. So over here we can see price taps into that target one IFC where the buyer's injection came in. We can actually additionally add that because we had this small run of liquidity, that this becomes an FU zone, and price taps into that FU zone. And what does it do? It gives you a bullish push, a strong bullish push, but look how it maintains supply. Look how it comes to that high where we have this liquidity over here, takes that liquidity, gives an inducement of this area, and then gives us the low. Price comes back, respects that area. So for me, it's telling me that yes, we might have a bullish push, but sellers are maintaining control, and therefore for me it makes sense to hold the sell, number one, and number two, the buyer's confirmation are not there just yet. So I'm going to continue to develop to see if there's a buy, and number two, it gives me further confidence to maintain holding volume on my sell and not taking more volume off, because we had a plan going in, and that plan can modify as price action develops. Price action developed favorable, so we maintain volume, as Wally mentioned just for you now.
And this actually is a perfect example of emotional attachments to the trade. If you see price came into a target one, then had such a sharp reaction up. If you hadn't taken up volume as soon as your alert triggered, that you came into your demand zone or you came into your target one level, most people would see holding 80% volume at this level here, they're going into significant, not drawdown, but loss of profit. And then they would emotionally react. Instead of taking 30%, you might close off the full trade thinking that this is such a sharp candle, it might break me even. And because you saw yourself at floating a certain amount of P&L, you're going to be panicking that you might lose that P&L. So you're not rationally thinking. And this is what taking profits at these levels, at these volumes, and at these percentages, it just allows you to detach yourself from the position. Think rationally at every single area and actually let the market do its thing.
Cool, let's actually push forward really quickly because this was not designed, and I know the community might get upset if we go too much into detail. So we're going to briskly run through it, show you how we advise the community, and show you that the previous targets, how they played out. So let's actually continue price. As you can see that it did retrace, and now something else is happening. Now we get an inducement of this whole area, and now we've mentioned the supply area. So we need to see how that's developing. Do we enter a buy, do we enter a sell, or do we just maintain and let price do its thing and let price develop? And again, you have to remember what is happening out of hours in terms of Asia versus what is happening in London. Again, I'm not covering this too much in detail, but you have to realize we as a community and liquidity inducement theorem students were entering buys and sells all over the place. But those are on an intraday perspective. What we are showing you is this one singular trade. But believe me, there were so many trades from the community where students bought here, students bought here, students did sell here, they also sold here. There's a lot of places where buys and sells are taking place. But today we want to cover for you guys the major trade and how the major management was. But there's actually a lot of things going on for things that we can't reveal on YouTube. But yeah, let's actually quickly run through further. I'm actually going to come on to H4 just to speed up the analysis, but actually it gives you a nice way to look at it from a higher time frame and not get lost in that lower time frame. Where are we? Remember, we were coming in bullish. We have tapped into that demand zone. We have tapped into a supply zone, and we are within range. So now we know that either one is favorable. Monitoring the lower time frames will develop that. We have secured profit, so we are not emotionally attached to that trade. We have paid ourselves from that trade, but we have left sufficient volume to know that if the sellers prevail, because we are on a high time frame weekly sell zone, we know that there is still longevity or further development of this trade to the downside possible. And that's why we have target 2 to take out our reaccumulation zone. And that's what very quickly happened. We took out that reaccumulation zone because sellers developed. I actually entered another sell over here, which I sent into the community. And now our weekly IFC, our daily demand zone, has been tapped into. Now, this is where Alex got into a buy. I actually sent in the full breakdown to the community, and this would be considered a hedge point. Now you can see from as we were breaking down earlier, this is a relevant point for us to be taking volume off the table and potentially looking for a buy. And this is actually where majority, how much did you advise the community to take out at this point, Wally?
So when we reached target 2, I advised the community to take out another 30%. So now there's only 20% running on that position because target 2 was already surpassed 1 to 100 risk to reward. Okay, now you're floating a significant amount of profit, and it was about reaching the actual demand level was only around another 50% more in terms of risk to reward. But price could at this moment in time, you're floating a significant amount of profit. You paid yourself a significant amount. Now it's not worth taking a risk of price turning around and you being taken out of the position. So by then, 80% of the trade had already been closed, and there's only 20% running. Now, I personally didn't manage to get into the buy, but which Alex managed to get into. But later on, I did see that buy. After about an hour after it played out, I saw the buy play out and the price action that was behind that buy position. So I closed off another 10%, and that was at around 1 to 150 risk to reward. So that 10% gave me another 15%. Now, I'm totally happy with the way the trade has played out. I got 10% running to either my swing target. I'll reevaluate at the swing target. But if not, because we're coming from a weekly level, that position can play out for another year. I'm not really too bothered if I break even on the position. I paid myself a significant amount in terms of ROI. I've done more than 90% from this position.
And actually, while it's worth adding as well, we have impulse from here. We have impulse from here to here. So, and we've tapped into our supply zone. So we know that we have had a bullish impulse with the characteristics we mentioned, and then retracement, which is our sell. Now, we don't know right now, as I said, it might be a retracement, it might be a new weekly impulse. We don't know, we can't forecast, and it's not our job to hope that it's going to be one or the other. We just play relevant price action. So we see we've got into that retracement, we've had that complex pullback into our decisional point, into a demand level. That has now significantly changed the characteristics because we have secured, in terms of RR perspective, 1 to 140, number one. Number two is our actual return on investment. Remember, risk to reward and return on investment, completely different things. And remember, a risk to reward profile is based on what is actually objectively seen on the analysis. Now, I might manage my trade completely different to Wally, who might trade it completely different to a retail trader, who might trade it completely different to a whatever strategy you're trading. There might be people who don't even do percentage risk. They might do plus and minus pip counts. So you cannot have a basis where you are judging a trade's performance based on risk to reward, because people might get the same entry, same stop loss, completely different ROI. And that's something very important. And in terms of portfolio management, it's not your goal to maximize a singular trade. Your goal is to maximize all your trades, and therefore some of them might be not as optimized and others might be more optimized, but you have a systematic approach to bring your average management up. And that's something we have created and something we teach in the boot camps that we do. But overall, even though we could have, looking back in hindsight, kept our 1% risk and let it play out for the entire 1 to 140 risk to reward, and therefore netted 140% on our account. The reason we didn't do that is because what if it came to target 1 and then reversed? that's a probable scenario that could happen because it's a bullish zone. Then we would have been floating 1 to 60 and then back to 0. So as you can see, just from that snippet, it's not ideal to just manage positions based on holding full volume. You actually have to manage it in a calculated way. And the way we calculated it was that we have our partial points, and when it comes to this demand level, we only have 20% of volume remaining, and that's what we leave and let the market do its thing. Obviously adding buys and sells at relevant areas, but that remaining 20% now is for our swing target. And if this swing target is taken out, remember, this is our structural point, and this is where it will confirm a bearish market to follow that weekly narrative. So on the chance that that does happen and it becomes a long-term swing, we are prepared, but we have not emotionally left money on the table that could have been actualized because we are hitting demand zones and therefore leaving money on the table. So actually, I think that nicely concludes this video without annoying the community too much, because they are always on our case if we go too into detail. But yeah, and once you guys join the bootcamp, you will see a lot more details, a lot more intricacies in how we develop trades and how we manage them. But yeah, that's what the community is there for. So guys, I do want to wrap it up there for today. A very nice video, and I do want to thank Wally for hopping on and joining us, because it was his wonderful signal. And although a lot of community members did catch that, although me and Alex did catch that, it was his analysis and it was his trade idea. And I know a lot of students caught into that trade also. As you can see, the difference between trade management and RR and ROI, again, there's a lot of things that are going into it. So as you can see, it's as detailed to get into the trade as it is to manage that trade. And I hope you got a flavor of that today. Yeah, just to finalize for this video, we always have a link in our bio. We always have a link in the description of the video, which is actually to book in a free discovery call with our student success manager. Now, in that call, you have to realize if you are to join us and join the WWA community, it is not for everybody. You have to be eligible. And within that call, you'll have an interview where we'll see if you are, because we are doing a program that is for advanced traders, not for new traders. And second to that, we want to see if we are even able to help you and also give you more information within that discovery call with our student success manager on what we offer, the kind of analysis we do, and more detail than you have seen in our videos. You'll actually see when the dates are, etc., etc. So I do implore all of you to book in a call with our student success manager, where you'll get more details, not only within our core program, WWA Trading Bootcamp, but also with our advanced liquidity inducement theorem course, where you're getting a more in-depth view on an intraday perspective. But yeah, guys, I hope you did enjoy that video. A lot of nuggets in there, so I do encourage you to watch it a few times and share with whoever you feel like it will be useful to. And I'd love to hear your feedback and engagement within the comment section, because we do this for you guys, and we'd like to see, do you like the collab videos like I've done previously with Alex and today for the first time with Wally, where we are taking it as a team, going into the analysis, showing both our perspectives? Or do you prefer individual breakdowns? Do you prefer different types of video as we've done, more lifestyle, more day in the life, more Q&A based? Whatever you guys want to see, do let us know in the comment section. If it's more breakdowns on what kind of trades, be it intraday, swing trade, trade management, entry types, or whatever it may be, we are here to give you guys value. So guys, thank you very much for tuning in today. Thank you for watching the whole video, because I know it is a longer one today, and I do hope you did find value. So guys, thank you very much, and I'll see you in the next one. Take care.